Flip, flop, flap, and smokes, everyone. There is panic in chaos in the markets today. The Federal Reserve has lost control of interest rates, and the stock market crash that you and I have all been waiting for is happening now. We have massive news to cover today. We have so much news, facts, and data to cover today. And I'm going to break down exactly what is happening in the markets, why all the markets are selling off, why we're seeing pretty much in everything crash right now, what this means for you, and how we can prepare or also possibly take advantage of the situation to make some money or make our digits go up. Because during every crisis, there is always opportunity. And for those that wait, those that are prepared, well, good things are going to be coming. So we saw a massive sell-off between all markets, stocks, bonds, okay. We saw precious metals sell off. We saw pretty much everything sell off today. So again, why exactly did that happen? Well, you know what time it is, everyone. Let's get straight into the news, the facts, and the data. But let me just go ahead and pull this report up. So go ahead and bring this up here. Just 1 second. Just bear with me, my technology is playing up here. So look at this. The Fed's Emergency Liquidity Program, BTFP, is over $100 billion. What's going on? Well, remember, this was just meant to be an emergency program for the banks. I'll move myself here so you can see this chart. But no, the Federal Reserve is losing control. And we can see here, the banks are having to borrow $107 billion every week because they have no liquidity. There's no liquidity out there. This is pretty much like an emergency program for the banks that was created by the Federal Reserve in March. So keep that in the back of your mind while I go over the news today that tells you that with these bond yields surging, there's going to be more bank failures. Because what caused the banks to go under? It was all interest rates going up and the bonds on their portfolio crashing. Well, the bond market is crashing more or is at lower levels now than it was in March. So let's have a deeper look, everyone. So look at this. Wall Street fear gauge ratchets up after jobs data. So I'm going to go over this report. Job openings report came in very hot. That's bad news for the Federal Reserve. That means they're going to have to lift interest rates much higher right now. Also, here it says 10-year hit 4.75%, but that's not accurate. It actually hit 4.8% today. So that's right. I said once we see the 10-year and the 30-year almost hit 5% today, the 10-year hit 4.9%, all hell is going to break loose in the markets. And I'll go over it more in depth why. We can see here 10-year hit 4.9%. So let's get into this report here. So the S&P fell 1.4% to a 4-month low, while the NASDAQ index dropped 1.8% after jobs openings unexpectedly increased in August. Also, there's huge drama happening right now in Washington. A House vote ousting Speaker Kevin McCarthy could fuel further uncertainty tomorrow. So we're seeing a lot of political uncertainty, which is definitely just going to get worse leading into the 2024 election. And I think this election coming up in 2024 is going to be unlike no other. So Wall Street's fear gauge, the CBOE volatility index, rose above 20 intraday. This is a key level signaling increased skittishness in the market and the highest such reading since May. Now, also the ICE, BOFA Move Index, which tracks unexpected bond volatility, also approached market peaks. So this is the volatility index, also the bond move index. They're all spiking. There is chaos and huge volatility in the markets right now. So among Tuesday's biggest losers were travel names, including Airbnb Inc. We're seeing here in Australia, they're putting massive taxes on Airbnb. I wouldn't really want to be investing in Airbnb right now, especially if you're in a very progressive country, because we're seeing a huge housing crisis right now. So a lot of politicians are going to be taxing Airbnbs to death. So it wouldn't be a good time to buy an Airbnb right now, because a lot of politicians are going to be going after Airbnb to increase housing supply. So in the cruise ship operator Carnival Corp, while McCormack and Co. slid after the spice distributor sales missed estimates, hurt by a slower economic recovery in China. There's another thing happening right now. The situation between the US and China is getting worse. We can see here Treasury Secretary Yellen says US overdependent on China for critical supply chains. And so that's another big risk for the market, is the deteriorating relationship with China. And also a big risk for the markets, for the global economy, is China is weakening, and China has been the one that's been fueling global growth, and especially for Australia as well. So she said she has not been a strong believer in industrial policy, but the United States has stood by for far too long while other countries have built up semiconductor industries with massive subsidies. That's exactly right. We also saw with pharmaceuticals, the US and the world is very dependent on China for pharmaceuticals, like what we saw during the pandemic. So the US would face national security concerns with a robust semiconductor sector of its own, she said, and that last year's Chips and Science Act would help reverse the trend. She said, we're fooling ourselves if we think that abandoning for all practices and purposes semiconductor manufacturing is a smart strategy for the United States, she said. So again, I just wanted to touch on that about the deteriorating relationship with US and China. Now, also in this next part of this report, so again, what exactly got the market so worried? It was this jobs report that just came out this morning, US time. So markets tumbled across the board after the number of available positions rose to 9.6 million from less than 9 million in July. So that's right. After all these rate hikes the Federal Reserve has done, they haven't been able to put a dent in the labor market. And I think central banks are in denial right now. They're panicking. They've played chicken with inflation. They said, we're going to smash inflation. We're going to stop inflation. So they've been pounding, lifting interest rates. But they know if they have to get interest rates above 6%, the whole financial system will come crashing down. So now they're trying to say, well, look, we just need to wait because we need to get some more data to confirm that inflation is still out of control. When we're seeing every single month the data's getting worse, and they're like, we'll wait another month because we're not sure this is a new trend. We can see here the central bankers are panicking because they know that inflation is now entrenched in the economy. And once it's entrenched, it doesn't go away in 1 to 2 years. It could take 5 to 10 years to get back down to 2%. So the report drove swap traders to increase wages on the Federal Reserve, raising rates in December better than 50-50. Now, I think it's almost guaranteed they should, but remember, that's based on, if you're using common sense. We know the Federal Reserve can sometimes rig the markets, especially if it's going to cause a huge financial crisis. So even though they should lift interest rates, it doesn't always mean they will. So we'll have to see what happens. So they said here, investors have yet to fully embrace the Fed's higher for longer narrative and are instead following the fickle market momentum. So that's exactly right. Over the past 15 years, we've been in very unusual territory, with interest rates being at 1% or 0. These are meant to be emergency interest rate levels. These are meant to be interest rates you have like during 2008, like what we had during COVID when the whole world was shut down. You're not meant to keep interest rates at 0 or 1%. But Wall Street seems to think that the Federal Reserve next year is going to cut interest rates back down to 0. And that's why we haven't seen a huge stock market crash yet. And I've been watching the markets, and I think, because sometimes the markets, they don't always get it right, okay? You can't just go by what the market does. The market gets things wrong all the time. I've been saying, why are stocks trading close to all-time highs when the Federal Reserve is still lifting interest rates? Because, again, remember, they talk about the lag effect, but that's the lag effect from when interest rates hit their peak. We're still in the rate hike cycle. The rate hike cycle hasn't finished. And like I keep talking about, even if the Federal Reserve doesn't do any more interest rate hikes, yields can still rise on bonds, and that makes interest rates on all debts. And that does the same effect like the Federal Reserve lifting interest rates 25 basis points. So a lot of people on Wall Street may have to get used to this is normal. 5% interest rates is a normal rate. When you look at the historic average of interest rates, 7% has actually been the average, not 5%. So we just have gotten back to normality, okay? Interest rates are not meant to stay at 0 or 1%. And I think Wall Street is now finally getting the picture that we may not see 1 or 0% interest rates for decades. So small catalysts are causing an outside number to attempt to preempt market moves as well. So the dominant market theme, therefore, is one that many developed market investors have not had to deal with since the 08-09 crisis, and that is volatility. That's exactly right. I'm just going to take a drink of water to let that sink in. Okay. So the next data report we're going to get for the labor market will be monthly payrolls, and that will come out Friday. And I'll definitely keep you guys all updated when that comes out. And so it'll be very interesting to see if this contradicts this jobs openings report, if it comes in weak or not. Obviously, if it comes in bad, if it comes in there's not much jobs created, then the markets will love that. If it comes in hot, we'll see more volatility like we're seeing now. But something tells me they might cook the books a bit there to keep the markets from tanking. So like I said, yields are rising. We can see with this chart here. I'll go ahead and move myself. Treasuries getting very, very close to 5%. Once they hit 5%, that's a huge psychological level. And pretty much think about it like this. Imagine if central banks have to keep on lifting interest rates and we get bond yields at 7%. Why would you even bother risking your money in the stock market, especially right now when stocks are still close to all-time highs, when you could get a guaranteed return, unless the government defaults, which could happen, but I don't think right now, when you get a guaranteed return of 7%, you wouldn't, because the average return is 9%, and that's when you're buying stocks at a good price. Right now, stocks are still severely overvalued, and we're going to go into we're going to get Q3 earnings results very, very soon, which will give us more insights on how these companies are earnings, because their earnings have been holding up, but I don't think that could happen for much longer. So thanks for the super chat. How does M2 money supply play into a lot of this? Well, simply every single time the M2 money supply goes down, we see a big stock market crash, because the Federal Reserve, I'll just go ahead and look this up, money supply M2 Fed, because every single time the money supply expands, we get a boom. Every time it contracts, we get a crash. So go ahead and bring that up here. We can see here, money supply hasn't contracted ever pretty much since the 80s. It's only gone up, and it went absolutely parabolic in 2000. And now it's been falling for the first time ever. And this is not a small fall. This is a rapid fall in money supply. So let's keep reading. Go ahead and move myself back here. So Wall Street strategists are warning about the impact that elevated interest rates have on equities, with Goldman Sachs Group Inc., Morgan Stanley, JP Morgan, Chase & Co. saying there is a risk of further stock market declines. That's exactly right. If you can get guaranteed risk-free returns, people aren't going to put their money in stocks, especially a lot of retirees. So this week's Treasury sell-off came after US lawmakers managed to avert a government shutdown, prompting traders to increase bets that the Federal Reserve will raise rates this year. Now, Atlanta Fed president, he said that they're going to have high rates for longer. I guess he was beating that drum on Tuesday, and that's what made the markets very, very worried. He's also forecast a single rate cut for 2024 towards the end of the year. That's right. He's only forecasting one interest rate cut. The markets want multiple cuts in 2024. So comments from the other Fed policymakers were more hawkish, with Cleveland Fed president saying on Monday that one more rate hike was likely needed, and Governor Michelle Bowman using multiple increases. So also at the same time, oil is up, and the yen currency just touched $150 per dollar before reversing. So we may see the Japanese central bank start selling more bonds, and they're the biggest holder of US treasuries, and that's why we may see the bond market selling off. So everyone, that's exactly why the markets are crashing today, because bond yields are surging. There's so much volatility. Interest rates are going to stay high for longer. What do you guys all think about this? But yeah, thanks for watching. You're awesome. I've got much more videos to pump out, much more news to cover. I'll see you all in the next video.